Hey, this is John from Gadeon Corp. Today I want to discuss some different valuation models for crypto assets with a focus on cryptocurrencies. So there are other kinds of crypto assets. We'll discuss that in a minute, but we're just going to focus on cryptocurrencies. So first, most of this information is taken from this resource here, Valuation of Crypto Assets, Guide for Investment Professionals for the CFAI, and these are the authors. So what kinds of crypto assets are available? Well, you have smart contract platforms, decentralized applications, and cryptocurrencies. So smart contract platforms. Basically, the smart contract platforms are kind of like an area for developers that allow them to write smart contracts, and decentralized applications. Decentralized applications are below. Smart contracts are effectively coded protocols that allow for the effective transfer of crypto assets. Now, decentralized application basically provide access to crypto products and services. So it could include a space to purchase cryptocurrencies. Cryptocurrencies are blockchain specifying value transfers, or the tokens that you buy effectively. Okay, so we're going to be focusing on cryptocurrencies. There are valuation models for the smart contract platforms and decentralized applications. They are similar in some respects. So, for example, you could value a decentralized application or a smart contract platform using a cost-based model. Now, some principles of valuation we're going to just quickly go through. So the first is that valuation should be based on value. And we want to be able to answer the question, why would investors pay more for the assets? Now, although this may seem rudimentary, it's important to remember because some of these models are based on, for example, cost of production. Is that really a good model to use for valuation? I think arguably no, because although it gives you an idea of what the costs are, it doesn't give you an idea of what people are willing to pay. So no one necessarily cares how much you spend on something, but they would care how much they would pay for that thing, and that can be independent of that, I suppose. So focusing on value. The second point is that we want to use typically more than one valuation model if possible, because each of these valuation models have particular limitations that may not let them capture all of the information effectively. So, for example, as I mentioned earlier, the cost of production model doesn't really do a good job of capturing value. So you'd want to couple that with something else, for sure. And then the last point that I'm going to make just in principle is that when creating valuation models, you want to make qualitative assumptions quantitative as necessary. So, for example, if you have an assumption such as the value of the currency is increased because its usability, or some other attribute that you might attribute to cryptocurrencies. Maybe it has a new type of, like when Ethereum got released and it's distinguished itself from Bitcoin with the use of smart contracts. Somewhere in the valuation model, that information needs to be incorporated. We can't just have it sit in a space of speculation. Okay. So the first approach that we can take going into the valuation models now is the total addressable market approach. So this one is relatively straightforward. Basically, in principle, we can take the asset and compare it to other assets. like you would with, say, a price to equity ratio and a relative valuation with a company. Now, here, though, I reference gold and the M2 money supply as examples of things you can compare it to, and you'll see below that's what they do in the article. There are different kinds of money supply. In the US, there's at least 3, so M0, M1, and M2. I'm not going to go through those, but you should be aware that they're different. But M2 money supply, I believe, is broad money supply and includes basically gives an idea of what inflation is, or this is the money supply indicator that you use for inflation. Okay, so the valuation model itself is pretty straightforward. All these ones are. Basically penetration times the value of the target market divided by the fully diluted supply. So, and then you can see below what those are. Basically, we are taking a percentage of the market that we expect the currency to take over and divide it by the total amount of currency in existence. So, in other words, you get an indicator of how much value does each coin capture in the market. Very straightforward. Now, we're just going to maybe quickly showcase an example of that. And this is pretty straightforward. So let's just set our variables, and this is basically how you do this in Python if you have never ever done this before. But let's say we expect it to take 20% of the market, and the market is a $5 million market. Let's say that's 50 million, whatever, $50 million market cap, and the supply of the currency is 1 million currency in circulation. Okay, cool. Then our total addressable market per coin is pretty straightforward. Now we take the penetration times the value of the target market and divide it by the supply, and then we're going to return our total addressable market per currency. Okay, and we get 10 in this case. Now just to make that more print with the capital, just to make that more explicit, right? There we go. Let's actually add a dollar sign. Okay, cool. So that's how we get that. Pretty straightforward, and that's how we get that to print. This is, by the way, how you would get images to load if taken from your computer, but basically fairly straightforward manner where you specify the path and then open up the image and convert it to the RPG color scheme. So anyways, this is a chart of comparing across different assets with the total addressable market approach. And yeah, you can see here basically what the value is at different levels of penetration using a fully diluted coin supply of 21 million. And yeah, moving down. So for example, if you take the gold market and you expect a 30% level of penetration, then you get this figure per coin, and so on. Now, yeah, anyways, okay, straightforward. Again, take comparable assets, the amount of the market that you're expected to capture with the coin, and then divided by the full supply of the coin. And by fully diluted, you mean accounting for any splits, basically. Okay, so the second model is the stock to flow model. Basically, it's kind of like supply and demand models. You treat it as a store value. you use a proxy, which is a proxy for scarcity, or your supply. And basically it's just a ratio. So we're going to take the stock divided by the flow. The stock is the amount in circulation, and the flow is the amount mined on an annual basis. And then we take the ratio, as you can see here, stock divided by flow. So very straightforward. So what does this tell us? It tells us, well, basically how much is out there, or how much is moving around, divided by the amount that it is increasing by on an annual basis. Okay, so unfortunately, there does not seem to be good evidence to support this approach. So this one isn't recommended, but it is a model, and this is one way that you can look at it. But basically, the market cap experiences much more variance than the stock flow model suggests. And, not all of these the models themselves aren't really going to be perfect reflections of reality. This one seems particularly bad, though. Okay, just moving on. Approach number 3 is Metcalfe's law. Basically, you take the square of the user count, or the amount of people that are currently using the currency. And so the idea is that we treat it as a network, like so. Okay, so basically from the data below, we see that it has about a 0.8, so below 0.79 correlation with the market cap of Bitcoin. And so it ends up being a relatively good valuation model, I'd say. But we can see here, right, that we take the 30-day moving average in the market cap. You can see here in the green, in the blue, and Metcalfe's law predictions for the value in the green. Now, you might be saying, okay, well, yes, the correlation is high, but the numbers are completely off, and you'd be right. So perhaps there should be a scaling factor applied to this model, but the movements seem to track reasonably well. So that's interesting. Now, this could change going forward, as these things often do, but historically this has been a good correlate. Okay, so what does this actually look like? We'll basically take a network. Well, so we can do that, right, and just take the value of the square user count, which is so let's just say user C equals 100. Then the value that you're looking at is user C squared. Right, like so. Okay, just so we're very clear on what that means. Now, the extended, we can take this and extend it to a network value to Metcalfe ratio. Basically, we take our market cap and divide it by the network value. So this is going to give us basically, well, how much how different is the market cap, or what percentage of the market cap is reflected in the network value. So, for example, we have a market cap of, I'll just take maybe an example from down here. So let's say our market cap is 800 billion. So I'm just going to put 800 for short. And that's fine, because these other ones are also in billions. Okay, and then our Metcalfe, or network value, is going to be, so when we went 800, we have one example down here, say about 200. Okay, and then our NVM, or network to value ratio, or network value to Metcalfe ratio, is the market cap divided by the network value. What does matter? Okay. And you see we get 4. Okay. Very cool. Now I think I did that backwards. Yeah. So let's just fix that. And yeah, okay, 25%. Okay, cool. Okay, next one's pretty, one that they obviously focused on the most. Not really a huge fan of this one, but in any case, you're typically going to take more than one. But okay, the fourth approach is the cost of production model. Basically, the idea is that we want to look at the mining costs, because crypto mining will create new coins and put new coins in circulation, but crypto mining does cost money for the miners. So there, ought to be some kind of compensation for them. And the idea, so we're basically going to be taking the, at least in the first set of models, is we're going to be taking the marginal cost of mining per day. So marginal basically means, well, how much does the cost change? So it's kind of, it's pretty much just your rate of change. So if you're, taking calculus, that's literally derivative, right? Cool. So now basically the model for the marginal cost, which is pretty straightforward. Like some of these things you are literally standardized units, like kilowatt hours. So we take dollars per kilowatt hours, times it by 24 hours in a day, and then we take watts per gigahash per second, and then we multiply that by gigahashes divided by 1,000, and then this gives us the marginal cost of mining per day. Basically, this has to relate with your hashing speed. Hashing speed basically helps you get through more problems more quickly, so that you can mine tokens faster. So, maybe give a very quick example of that. Let's say, it costs, so your dollars per kilowatt hour, okay, so cost per kilowatt hour, let's just say it's $1. There's 24 hours in a day. We are going to take the watts per gigahertz per second, and we're going to say it's, I don't know, 100, let's say. We have gigahashing, not gigahertz. I keep saying gigahertz. Gigahash is, I don't know, going to be 200, for example. Okay. So then obviously to get the marginal cost per day, we're just going to take the cost per kilowatt hour, multiply that by 24, multiply that by watts per gigahertz seconds, and then divide it by gigahertz, gigahash, divided by 1,000. Okay, then we're going to print the marginal cost per day, and we get 480. Now, probably an extremely unrealistic model. I'm just giving you an example of these things, and so you can go and fill that in with your own information. Okay, now the next set is to look at the price per the price of the Bitcoin. So the idea is that we want to base the price on a number of factors you see here. So we take the price times the number of Bitcoin per day that are in production, multiplied by theta, beta, rho, divided by delta. And these are basically just placeholders. So you can see here, we have beta is the block reward, so how much reward you get for mining. We multiply by the hashing power, divide by the difficulty. The difficulty basically is how complicated are the problems that you're solving. And then theta is a time constant using these units here, as you can see. And this gives you the normalized probability. So you take the probability, put it on a normal distribution, standard deviation 1, mean 0, and of single hash solving a problem or block. Okay, so now let's just run through what an example model could look like. We'll actually place this below. Okay, so prices, let's say 10,000 BTC per day. Say, I have no idea how much how much is getting produced in a day right now. Your block reward is 10 whatever row. And this is in gigahashing or gigahashes. So let's just go with the previous one, say 200. I think that other miners, like a lot of them are closer to 800 gigahash now, though you can get some that are terahashing as well. So anyways, okay, delta is the difficulty, and this is in gigahertz per gigahashes per block. So let's just say, I don't know, 100. And theta, which is your time constant, this is given, so we're going to take 24 times 3,600 seconds, and this is basically 24 hours in a day, 3,600 seconds in an hour, so we're taking the number of seconds per day effectively, and then we're multiplying it by 2 to the negative root 32. This is also the same as dividing it by 2 to the 32. Okay. Now our price times the BTC per day is equal to, let's just isolate our price instead. So you're going to take theta times beta times rho divided by, put these in brackets, delta times our BTC per day. Because again, we're just isolating the price here. Okay, and that's what we get for the price under this silly little model. Okay, now for perfectly competitive market conditions, you can see that this is the relationship that we get. So basically, the idea is that in perfectly competitive markets, where no one can take profits, then we have the marginal cost per day is equal to the price times the number of Bitcoin in production per day. In other words, our price can be an effect of the marginal cost per day to produce it divided by the number that is produced per day. So, in other words, the price is the change in price per day divided by the number that gets produced per day. So, straightforward. In other words, the price at which a miner would operate at a marginal loss. Okay. Now, I've discussed my theoretical concerns with this. Namely, it just doesn't really reflect the value of the coin. It reflects the cost of the model. But if, for example, if you had a company that you're looking at, you probably wouldn't, decide if you were or were not going to invest in it based on a model of its expenses. How much did this company spend? Doesn't really matter. So there's that. Despite my concerns, Hayes in 2019 showed with a vector autoregression model that the statistical correlation between basically the marginal cost of production and the price had been pretty good. So that's, well, maybe it doesn't matter if I am right or wrong about the theoretical concerns of the model. But obviously this can always change going forward, as often history shows, things that were historically true are not always true in the future. So same thing could be said of a model like this, and so maybe it's just a statistical artifact so far that this has a correlation. Okay, and then there's some other complications as well that make this difficult. So the first is that delta, or difficulty, changes on about a bi-weekly basis or every 2016 blocks. That will obviously require the model to get updated. Then another thing is the block reward changes approximately every 4 years. So the reward for mining gets cut in half as new Bitcoin gets put into circulation via like its version of a splitting mechanism. So the block reward and the delta, or the difficulty, changes every so often. And that can make the model somewhat impermanent. Okay, now just to finish this off, there's a couple other metrics that we can look at. One is the network value to transactions ratio. Basically, take the market cap divided by the number of transactions occurring in the market. Problem is with basically you're going to take estimates to measure or estimate things like the transactions volume in particular, and these tend to be inaccurate. So this isn't a great ratio to work with. And the other is the market value to realized value ratio. So we take the market cap divided by the realized capitalization. And this is basically your cost basis for all owners. So it's kind of along the same lines of the cost production model. We are relating the value to the cost of the currency. Okay, now basically the idea is that if this ratio is above 1, then it's more valuable. If it's below 1, then it's less valuable. And this should be straightforward to understand why. Basically, if it's above 1, then your market cap is above your realized capitalization, or your cost basis. And if it's below 1, then your market cap is smaller than your cost basis. So a high ratio, let's say, if this were 5, what may signal unrealized profits that will then allow you to go in and take a profit. And low values may indicate that it's potentially overvalued, or this is a market bottom. That the price is at a cyclical low. Okay. Anyways, so that's obviously the end of that. If you enjoyed this video, then you can like, comment, subscribe, share it, and I'll make another one in the future at some point. Okay, bye.